to the loan officer training series with the mortgage calculator. We will get started in just a minute here. Let us go live on all the different platforms. It does take a little bit to get live everywhere. We are streaming this on YouTube, Facebook, and LinkedIn. So it will take just a moment. And in the meantime, we put the chat up on the screen. So feel free to drop comments. I see a lot of people were commenting already. We appreciate the comments, everybody. Owen, Leonardo, Julio, Meg, Chad. Appreciate the comments. As people tune in, feel free to drop a comment there for us. And we'll get started here in just a moment. We have a great topic here today, great presentation that we're going to be going through. So I'm glad everybody is on here. Jason, thank you for commenting there from LinkedIn. Dario, thank you for the comment. We appreciate it. And it looks like we are ready to get started. So as we go through here, feel free to keep dropping comments there in the chat and drop any questions that you have as well as we go through the presentation. And Jose will try to answer your questions as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is our loan officer training series. So we do a different topic every week. And today's topic is going to be loan appraisal types. So I'm going to let Jose get right into it. Our sales manager, Jose Gonzalez, with 28 years of experience as both a loan officer and a realtor, has a presentation to go through here. We'll talk about loan appraisal types. So go ahead, Jose.
Sorry about that. I had to unmute myself. So let's get right into it. Appraisals are, in some cases, can be a very pivotal point in a transaction, right? But it's not just the appraisal valuation that can be an issue. It's getting the appraisal order off on the correct foot, right? You want to be able to ensure that you are ordering the correct appraisal for the transaction. So let's get down to the very basics, right? What is an appraisal? An appraisal is a formal opinion of value. For the deals that we do here, they need to be completed by a licensed appraiser for any of our agency or non QM loans. Uh, so we always do need our full appraisal. Our approaches are going to be either the cost approach, the sales approach, which is the most common approach. That's the comparable market, sales, all that kind of stuff, and the income approach. The cost approach is more popular with like developers just looking to properly price their inventory, and the income approach is more suitable for commercial deals where the capitalization rate that the property has is what is going to more accurately determine the value, right? Your net income will determine your property's value in the commercial world. In the residential world, you're looking at the sales approach, whether it's for a purchase or for a refi.
So like 99% of what we do is going to be the
Yeah,
sales approach.
correct. Going to be the sales approach. Now we have different types of appraisal, whether it's a full appraisal, right, where they're gonna, your typical appraisal that they're gonna measure, take interior, exterior photos, property condition, neighborhood, all that kind of good stuff. Then you have an exterior, which is similar in everything to a full appraisal, except they only are going to inspect the exterior of the property, no interior measurements, no interior photos. Everything is the exterior. That's more for like a HELOCs or a foreclosure. And then you have your BPO, which is still a type of appraisal, but it's not necessarily completed by an appraiser. It's usually going to be completed by a real estate agent or a real estate broker. Those were very popular during the time of the short sales, and when REOs were super popular, BPOs were the thing. So full appraisal, exterior only, or a BPO. Now, we have many types of appraisal forms, right? This is where it can be confusing, and I have slides for each of these, but this is the whole list of all the different types of numbers. And this is where it's important that you get your transaction off on the right foot. So this is why we're having this training to make sure that you understand when you have a certain type of property is going to require a certain type of loan. Now, on your agency loan, it's a little bit more cut and dry. You're going to have an automated underwriting approve eligible if it's desktop underwriting, or accept if it's loan prospector, that's Freddie Mac. Desktop underwriting is Fannie Mae. So you're going to have your findings, and your findings is going to tell you the appraisal form to order. So if it's a condo, it's going to tell you need a 1073. If it's a 2 to 4 unit, it's going to tell you need a 1025. However, when you are in the non-QM world, you do not have an automated underwriting report. No, you do have guidelines for the investor where you're going to be submitting the loan if it's non-del, or for the lender if you're going to be brokering the deal, right? So there are guidelines, and those guidelines could give you some guidance on where this actually has to, what is the report type that you need to have. So what are the different reports? Well, the most common one is the 1004 single family residential property report, right? So 1004 is for single families, which can also include PUDs or townhomes. Now, what is a PUD? That's a single family home in a development that has a homeowners association. And a townhouse would be an attached single family home, which could be, typically is in a PUD. Most townhouses do have HOAs, but not 100% of all townhouses, which are attached single family homes, have an HOA. So 1004 is single families and PUDs, to include townhomes. Now, if you have a condo, an individual condo in a building, that is a 1073. Again, you have interior and exterior photos and inspection, but there are many fields in the 1073 that are going to be specific to condos, like how many units, total units in the building, how many units owned as, tenant occupied, how many units owned by the owner. So there will be different categories, and what's the association fee. So there'll be different categories that would be condominium specific on the 1003. So you want to make sure, obviously, that you order the correct form. A 2055 is an exterior only single family residential appraisals. Again, single family here for PUDs and townhomes, and that's why you don't want to confuse getting back to condo and single family, because both of those are one unit property. A condo is one unit, single family residence is one unit, but obviously one is a condo and the other is not. So the 2055 is usually only going to be applicable on a low loan to value, or when access to the interior is limited. It costs less than a full appraisal. However, just because access is limited doesn't mean that you can automatically order a 2055 and that the lender, investor, or underwriter will accept it. Okay, so you have to, if it's automated underwriting, look at the findings. If it's non-QM, you're going to have to check with the investor and the guidelines to make sure that you would be able to use that 2055. 1075 is exterior only, but it is for a condo. So again, Same rationale as to why you would use it. They just changed the number. 1075 is for individual condo units only. Now, 1004C, and I specifically picked this photo of a manufactured home because I wanted you all to visualize how a manufactured home, at least a double wide like this one, is transported to its final resting point, the land where it's going to transition from being a mobile home, which is basically a trailer, to like a vehicle trailer, to a manufactured home, which is permanently affixed to the land via foundation, has a folio number, it has transition from a vehicle title to a deed, right? So that's our manufactured home, and a manufactured home appraisal has a 1004C as in Charlie, because again, many manufactured home specific fields in this appraisal. Uh, of importance to note here is that the appraiser is going to have to take photographs, and they have to be legible, right? Photographs of the two HUD decals that are outside in the corners of either corner of the structure. You're going to have two decal plates, one for each half, and then you're going to have a HUD data plate inside the property. If for whatever reason the appraiser cannot locate them, then verification letters will need to be ordered to verify the data plate and the decal. So make sure that you take that into consideration when disclosing these files. They're approximately $250 per letter. It would be 2 letters you would need. Now, this is one where there's a lot of confusion. Now, the 1004C, obviously, you could easily order a regular 1004, but here's another one where every now and then we get people ordering a 1004 instead of a 1025 when we're dealing with a 2 to 4 unit property, right? So keep that in mind. 2 to 4 unit properties, a small residential multifamily, duplex, triplex, fourplex, and it is a 1025 and not a 1004. Now, keep in mind, this would be applicable, even though this report is more for investment properties, but it would be applicable if it's a primary residence as well. It's going to be primary for the one unit they're going to live in, and then the other 1, 2, or 3 units, depending if it's a 2, 3, or 4 unit, are going to be investment. So you would need to have this report, but it's applicable for primary or investment properties as well. Now, 1004D is another confusing document, and one that a lot of times gets our MLOs in trouble because they forget to disclose that additional cost, because the 1004D usually comes after the fact, right? The underwriter reviews the appraisal, notes photos that show there may be damage to the property, so they may require an inspection, or the original appraisal could have been done subject to certain repairs that the appraiser themselves noted in the original appraisal, subject to whatever replacement of missing bathroom vanities, right? Maybe there was nothing there.
What about the hurricane that just came through?
Oh yeah, no, yeah, thanks. That's a very pressing situation right now. So you have to be aware of those disaster bulletins that are being released now by all of the different investors, citing different requirements for properties located in certain counties in certain states. So, like in Florida, I think there's like six or 8 counties that were designated disaster zones or areas, whatever you want to call it, and now they're requiring 1004Ds, this reinspection, to prove that the property wasn't blown away by the hurricane and that it's still in the same condition that it was when it was originally inspected. Now, a little bit confusing is that this could also be used to update the appraisal. So there's two 1004Ds. One is the reinspection form, and the other one is updating, like a recertification, I guess you'd want to call it, of the appraisal. So they're both, for whatever reason, called 1004Ds. So now we have our 1007, which is our single family rent schedule. Now, this is another form that gets confused because this form is applicable only for one unit properties. It could be a condo, or it could be a single family detached, or a single family attached, which is a townhouse, but it's for one unit rental properties only. You would use a 1007, which is a market rent schedule, right? So that it's a supplemental form to the 1004. So it's an additional item. You got to remember to order it when you have your investment property. You have to order if you have your one unit investment property, you have to order the 1004 and the 1007 market rent schedule.
Hold on, Jose. I just want to touch on that. That's the big one that we deal with, right? We specialize in DSCR loans here. That's our favorite product. And that's what you're ordering on a DSCR, right? We're going to order our 1004, and then our 1007 is going to tell us our rent for the DSCR ratio.
Correct.
Right?
As long as it's a one unit property, whether it's a condo, townhouse, or single family, you would order the 1007. Correct. And this is what you have to know when they're talking about, when you're reading the guidelines and the property is currently rented, for example, and they're going to tell you they're going to use either the lower of the 1007 or the rent value. Maybe they'll use the rent value if it's higher if you provide 3 months, but the 1007 form that they're referring to is this 1007 form. So you know when you're reading the guidelines what they're talking about. Now, the 1007, again, sometimes is mistakenly ordered instead of a 216, and it usually happens at the same time that the 1004 is mistakenly ordered instead of a 1025. Because whereas the 1025 is the appraisal form for a 2 to 4 unit property, the 216 is an operating income statement that is ordered when you have a 2 to 4 unit property. Now, mind you, they're not really going to be using the net income as the income for the property, but that is just a form that's used for the 2 to 4 unit. They're mainly going to be looking at the gross rental income amount that's put into the property and the market rent, not the net income. So that would be whether it's a full doc investment property 2 to 4 unit, or whether it's a DSCR. If it's a 2 to 4 unit, it will be using a 216 operating income statement. Now here's a couple of more we hardly ever order these, right? But for our true commercial, or for our 5 to 8 unit, this is why it's really important when we have our 5 to 8 unit properties, you look very well and confirm what is the appraisal type you need to order. They may give you different directions for the 5 to 8 unit, because that's like a hybrid, like a hybrid program. So it may be different, than having to order a 71A or a 71B. So just keep an eye out. 71A is just a multi-family appraisal for 5+ units, right? And true commercial appraisal. And the 71B is a condensed version of 71A. Now, the 71A and B, they're going to use for the smaller multifamily. I'm talking about not 4 units, but smaller for commercial sake, right? Because if it's something too large, they're just going to use a general purpose commercial form, and then they'll just have like a really long narrative and write with their experience however they feel that the appraisal needs to be written. But if it's a smaller multifamily, they'll use the actual 71A or the 71B condensed form. And we got a couple of newer forms that came across recently. One here we have our 70D, which is a 1004 desktop for single family homes. So this would be an appraisal, just like the phrase suggests, it's completed at your desk, right? Without having the appraiser do a physical inspection of the property. So every now and then, this may be requested in some cases when like there's a second appraisal that is required. Sometimes they'll let it be a desktop rather than a full review, rather than a full appraisal. So you do have to look at the guidelines, and if in doubt, check with the investor. And our last appraisal form here is our 1004 hybrid, or our 70H, is again for single families. This is similar to the 70D, but instead of no inspection, it has a third party go and inspect the property instead of the appraiser. And the appraiser then receives the report from the person that went to do the inspection, and then the appraiser completes the report. So it's like they just send somebody out to measure, take photos, stuff like that, and the appraiser just hangs out in the office, compiles the data, completes the analysis, and sends the report out.
All right. Well, it looks like we do have a question here. If you, is that all,
Yes,
Jose?
sir.
Are we wrapping up here?
Well, I mean, there's another appraisal I didn't note here because it didn't really have a form for it, but it would be the ARV appraisal, which is that question that we have here apparently. So for a fixed flip DSCR, is the appraisal going to go by current rents or projected market rents? Okay, so that you're assuming now that the fixed flip property is rented and in a condition to be rented. I mean, that's a tough question there. Are they going to go with, because if you have it currently.
Those are two different things, right?
Yeah.
Fix and flip is not a DSCR, right? So those are
Yeah.
two different loan types you're asking there.
Yeah.
Fix and flip would use a as is ARV, which is what Jose's talking about, which is they would just add a ARV after value to whatever report you have. So that's fix and flip. DSCR is just the rent analysis. So two different types of reports for two different types of loans there.
Right, because on the fixed flip loan, what they're really looking at is the profit in the flip. Obviously, if it's a fix and a hold that you're going to be keeping the property, they will be obviously concerned with what you're going to be able to rent it for and what is your exit strategy to refinance out of that loan. But they're for the flip part, they're looking at the flip. What is the profit in the flip?
You want to talk a little bit, Nick, about the fix and flip, fix and hold, and how essentially most of the time we're looking at two loans here, right? If we're gonna do a fix and hold, right?
Oh yeah, I mean it's always two loans, right? There's no long-term fix and flip for an investment property, right? It's always a short-term bridge loan to do the fix and flip. So the DSCR is always a long-term loan to hold a property based on the rent. So two totally different types of loans. Of course, you can do a fix and flip with your exit being to do a DSCR long-term loan if you were going to hold it, like Jose was saying. So they're going to ask you a question during the loan application process of, are you going to sell this? And then they use one type of analysis. If you say, I'm going to rent this and I'm going to refinance this, then they're going to use another type of analysis just to make sure that the property is refinanceable, right? If you're going to sell it, they need to know that you're going to make money when you sell it. If you're going to refinance it, they need to know that you're going to get enough money back to refinance it, and that it does make enough money to refinance. So two different strategies there for sure.
All right, great question. Got some great answers out of that. Okay, well, I don't see any other questions, so I think we can wrap it up. Remember, we'll be right back here tomorrow at 7 p.m. Eastern with a different topic, because we do this every Tuesday and Wednesday, 7 p.m. Eastern time. We appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. Thank you, everyone, and we will see you tomorrow, 7 p.m. Eastern time, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Take care, everyone.
Thanks, everybody.